Hi, and thanks for joining me. Today we're going to talk about the basics of investing. We're going to talk about low and medium risk investment tools. We're going to brush a little bit on the high risk investment tools just in case you're wondering where they fall on the spectrum. But my name's Carol Roberts. I'm the Community Resource Development Agent for the University of Florida IFAS Extension in St. Lucie County. We're going to have a great time today talking about the basics of investing, so let's get started. Before we start talking about the specific investment tools, it's important to know when you're ready to start investing. So before you invest, you really want to develop your financial skills. Make sure that you have a control of your debt and you are managing your expenditures so that you can reduce expenditures and free up some money for investing. You also want to make sure that you have already established your emergency fund. It's not wise to invest money that you need to set aside for your emergency fund. We'll talk about that in a minute. And we want to make sure that we know our goals with our investing. What are your financial goals? Where do you intend to be a year from now, 5 years from now, or even 20 years from now? Knowing your financial goals will help you determine what tools you want to use for building your investment portfolio. Also, you want to make sure you learn about those different tools and decide which one is right for you. It'll make a difference on what tool you use, especially after you look at what your level of risk tolerance is. Your risk tolerance is going to be affected by your comfort level, your knowledge level of the different investing tools. So you want to make sure that you're ready to choose the tool that you do and you understand what could go right and what could go wrong with that investment. Before we talk about investing, let's talk about who can invest. Well, anybody can. You want to be comfortable with the tools that you use to invest, and you want to know what your goals are going to be. We're going to talk about all that, but first I'd like to play for you just a short video that is an inspiration to maybe people who don't think that they're the type of people who can invest. So let's see what this little short video has to offer.
I was 14 years old inside of a bowling alley, burglarizing an arcade game. And upon exiting the building, a security guard grabbed my arm, so I ran. I ran down the street and I jumped on top of a fence. And when I got to the top, the weight of 3,000 quarters in my book bag pulled me back down to the ground. So when I came to, the security guard was standing over top of me and he said, "Next time, you little punk, steal something you can carry." I was taken to juvenile hall. And when I was released into the custody of my mother, the first words my uncle said was, "How'd you get caught?" I said, "Man, the book bag was too heavy." He said, "Man, you weren't supposed to take all the quarters." I said, "Man, they were small. What am I supposed to do?" And 10 minutes later, he took me to burglarize another arcade game. We needed gas money to get home. That was my life. I grew up in Oakland, California, with my mother and members of my immediate family addicted to crack cocaine. My environment consisted of living with family, friends, and homeless shelters. Oftentimes, dinner was served in bread lines and soup kitchens. The big homie told me this: money rules the world and everything in it. And in these streets, money is king. And if you follow the money, it'll lead you to the bad guy or the good guy. Soon after, I committed my first crime. And it was the first time that I was told that I had potential and felt like somebody believed in me. Nobody ever told me that I could be a lawyer, doctor, or engineer. I mean, how was I supposed to do that? I couldn't read, write, or spell. I was illiterate. So I always thought crime was my way to go. And then one day, I was talking to somebody and he was telling me about this robbery that we can do. And we did it. The reality was that I was growing up in the strongest financial nation in the world, the United States of America, while I watched my mother stand in line at a blood bank to sell her blood for $40 just to try to feed her kids. She still has the needle marks on her arms to this day to show for that. So I never cared about my community. They didn't care about my life. Everybody there was doing what they was doing to take what they wanted. The drug dealers, the robbers, the blood bank. Everybody was taking blood money. So I got mine by any means necessary. I got mine. Financial literacy really did rule the world. And I was a child slave to it, following the bad guy. At 17 years old, I was arrested for robbery murder. And I soon learned that finances in prison rule more than they did on the streets, so I wanted in. One day, I rushed to grab the sports page of the newspaper so my cellie can read it to me. And I accidentally picked up the business section. And this old man said, "Hey, youngster, you pick stocks?" And I said, "What's that?" He said, "That's the place where white folks keep all their money." And it was the first time that I had saw a glimpse of hope, a future. He gave me this brief description of what stocks were, but it was just a glimpse. I mean, how was I supposed to do it? I couldn't read, write, or spell. The skills that I had developed to hide my illiteracy no longer worked in this environment. I was trapped in a cage, prey among predators, fighting for freedom I never had. I was lost, tired, and I was out of options. So at 20 years old, I did the hardest thing I'd ever done in my life. I picked up a book. And it was the most agonizing time of my life. Trying to learn how to read, the ostracizing from my family, the homies. It was rough, man. It was a struggle. But little did I know, I was receiving the greatest gifts I'd ever dreamed of. Self-worth, knowledge, discipline. I was so excited to be reading that I read everything I can get my hands on. Candy wrappers, clothing logos, street signs, everything. I was just reading stuff. Just reading stuff. I was so excited to know how to read and know how to spell. The homie came up and said, "Man, what you eating?" I said, C-A-N-D-Y, candy. He said, "Let me get some." I said, N-O, no. It was awesome. I mean, I can actually now, for the first time in my life, read. The feeling that I got from it was amazing. And then at 22, feeling myself, feeling confident, I remember what the OG told me. So I picked up the business section of the newspaper. I wanted to find these rich white folks. So I looked for that glimpse. As I further my career in teaching others how to financially manage money and invest, I soon learned that I had to take responsibility for my own actions. True, I grew up in a very complex environment, but I chose to commit crimes, and I had to own up to that. I had to take responsibility for that, and I did. I was building a curriculum that could teach incarcerated men how to manage money through prison employments. Properly managing our lifestyle will provide transferable tools that we can use to manage money when we re-enter society, like the majority of people did who didn't commit crimes. Then I discovered that according to MarketWatch, over 60% of the American population has under $1,000 in savings. Sports Illustrated said that over 60% of NBA players and NFL players go broke. 40% of marital problems derive from financial issues. What the hell? You mean to tell me that people work their whole lives buying cars, clothes, homes, and material stuff, but we're living check to check? How in the world were members of society going to help incarcerated individuals back into society if they couldn't manage their own stuff? We screwed. I needed a better plan. This is not going to work out too well. So I thought, I now had an obligation to meet those on the path and help. And it was crazy because I now cared about my community. Wow, imagine that. I cared about my community. Financial illiteracy is a disease that has crippled minorities in the lower class in our society for generations and generations. And we should be furious about that. Ask yourselves this: how can 50% of the American population be financially illiterate in a nation driven by financial prosperity? Our access to justice, our social status, living conditions, transportation, and food are all dependent on money that most people can't manage. It's crazy. It's an epidemic and a bigger danger to public safety than any other issue. According to the California Department of Corrections, over 70% of those incarcerated have committed or have been charged with money-related crimes, robberies, burglaries, fraud, larceny, extortion. And the list goes on. Check this out. A typical incarcerated person would enter the California prison system with no financial education, earn 30 cents an hour, over $800 a year, with no real expenses, and save no money. Upon his parole, he will be given $200 gate money and told, hey, good luck, stay out of trouble, don't come back to prison. With no meaningful preparation or long-term financial plan, what does he do? At 60, get a good job or go back to the very criminal behavior that led him to prison in the first place? You taxpayers, you choose. Well, his education already chose for him, probably. So how do we cure this disease? I co-founded a program that we call Financial Empowerment Emotional Literacy. We call it FEEL. And it teaches how do you separate your emotional decisions from your financial decisions. And the 4 timeless rules to personal finance. The proper way to save, control your cost of living, borrow money effectively, and diversify your finances by allowing your money to work for you instead of you working for it. Incarcerated people need these life skills before we re-enter society. You can't have full rehabilitation without these life skills. This idea that only professionals can invest and manage money is absolutely ridiculous. And whoever told you that is lying. A professional is a person who knows his craft better than most. And nobody knows how much money you need, have, or want better than you, which means you are the professional. Financial literacy is not a skill, ladies and gentlemen, it's a lifestyle. Financial stability is a byproduct of a proper lifestyle. A financially sound incarcerated person can become a taxpayer citizen. And a financially sound taxpayer citizen can remain one. This allows us to create a bridge between those people who we influence, family, friends, and those young people who still believe that crime and money are related. So let's lose the fear and anxiety for all the big financial words and all that other nonsense that you've been out there hearing. And let's get to the heart of what's been crippling our society from taking care of your responsibility to be better life managers. And let's provide a simple and easily to use curriculum that gets to the heart of what financial empowerment and emotional literacy really is. Now, if you're sitting out here in the audience and you saying, oh, yeah, well, that ain't me and I don't buy it, then come take my class. So I can show you how much money it costs you every time you get emotional. Thank you, guys. Thank you.
So why do we need to talk about risk when we're talking about investing? Well, investing is a risk. It's legalized gambling, basically. You're taking a chance that that company is going to do better than it's doing today, in most cases. We'll talk about that in just a minute. But your risk tolerance is relative to your the amount of money that you have to invest. If you're investing all your money that you have available, it's kind of scary to think that you could lose it all. But if you have a lot of money and you're just investing part of it, well, it's not so stressful if things don't go as planned. Also, your risk tolerance is relative to your time horizon. How much time do you have between now and when you plan to retire? Do you have enough time to recover in case you have chosen a more risky investment and it didn't pan out? That could be a problem. So there is a certain level of stress when you get closer to needing that money to live on. than when you're further away and have time to recover from a loss. Also, it's relative to your understanding of the tools that you're going to use to invest. And we're going to talk about those tools coming up in just a second. But my grandmother had a favorite saying that I love and I like to recount for you: spent money never wins. Grandma was a gambler. She loved Vegas, but that was her rule: spent money never wins. You don't take the rent money and gamble with it. You leave the rent money because that's already spent, and you take your extra money, stuff that isn't allocated to your household expenses and other needs. That's the money that you invest with. And we're going to talk about that too. So when you're investing that unspent money, well, what do you need to know? Well, you need to know your goals. What do you plan to do with this investment? Are you investing so you have can grow an emergency fund that's already established and make it bigger to provide you a safety net? Or are you looking for some sort of income on a regular basis from these investments, or some combination of these things? That's possible with investing. You want to make sure that you diversify to reduce some of the risks, because you've heard the phrase, don't put all your eggs in one basket. If you put all of your investment dollars into one investment product, if that product doesn't perform as you expect, then you've lost it all. If you put your investment dollars in several different kinds of products, most likely not all of them will underperform. Most likely all of them will not overperform. There will be some balance. That's called diversification. You also want to make sure you know who's going to manage your investment. Are you going to try to do it yourself? Do you know enough about the market and investing tools that you can, or do you want to pay somebody to manage your investment for you? And we're going to mention that a little bit when we talk about tools. Also, find out about liquidity. Liquidity is a phrase that basically means how fast can you turn this investment tool back into cash. A home, for instance, is a very valuable asset, but it's not very liquid, because if you need the money from that home, you need to get somebody to buy that home from you for the amount that you're looking for. If you're in a real rush, you may take less than its value, and then you might have taken a loss. But if you need that liquid cash, then you want to make sure that you're dealing with investment products that are more liquid than solid. Cash is the ultimate liquid. And we want to know how to look up the performance record of an investment that we're interested in. How do we know if this is a good investment? Well, we can't predict the future, and anybody in the investment world that says they can, that should be a big red flag. But we can look at the past performance to get an indication of how that investment might perform in the future. But like we said, gambling is a risk. There may be an indication that investment will pay off or grow, but there's no guarantee. Absolutely no guarantees in investing. So the first place we're going to start is to talk about some low-risk investment tools. You see this list on your screen? Well, we're going to talk about each one of these, from savings accounts to government securities, and then the ultimate liquid investment, cash. Some people wouldn't think of an insured savings account as an investment tool, but it is. It's a place to hold your money and to grow it. So, and the nice thing about a savings account is at your bank, it would be FDIC insured. That's the Federal Deposit Insurance Corporation, and they are a federal agency that insures your bank accounts up to $100,000 per account per person in case of a bank emergency. If you happen to have an account with a credit union, your account would most likely be NCUA insured. That's the National Credit Union Association. They also insure bank accounts up to $100,000 per person per account just like the FDIC does. So yes, your money is safe. If there's a problem with that bank, a run on the bank, you are guaranteed to get your money back. I hope to someday have more in a savings account than the FDIC might insure. That's a goal. Also, a savings account is pretty liquid. You can access your money anytime. You go to an ATM machine and withdraw it. You can earn interest. It is a place to grow your money, but not a lot of interest. Most bank accounts and credit union savings accounts will pay you what, maybe 0.0102%. That's not a lot of interest. It's really not an incentive to save. There are some online savings accounts that will pay a little bit higher, maybe up to 1% on compounded monthly on your balance. But they're, because of the economy at this current time, those online savings rates are falling as well. However, it is more than your local bank can offer, and it might be something to look into. Make sure any online savings account that you choose is FDIC or NCUA insured, and that the money's accessible to you. I have an online savings account myself, and it gives me comfort to know that that online savings account company is backed by an actual brick and mortar bank. It's not necessary, but for me, my level of risk tolerance, that makes me feel better. So insured savings accounts, compound interest is like a miracle. They pay you interest on the money you put away, and then next month they pay you interest on the money you put away and the money they already paid you for what you put away. So it really can snowball if you don't touch it. So that's the information about savings accounts, which is a very simple, safe investment tool. They're very easy to use, aren't they? And you can find savings accounts that are no fee, no minimum balance. They pay you compound interest, and you want to look for the highest annual percentage yield possible when you're looking for a savings account. A money market account is a lot like an insured savings account, but it's a lot like a checking account as well. It's like a savings account because you can earn interest on the balance you carry in your money market account. You can end up paying no fees if you maintain a certain dollar amount for your minimum balance. It's usually a very high minimum balance, but if you can maintain that, you'll earn interest on the money that's in that account and be able to write checks out of that account or make withdrawals. So yes, a lot of money market accounts offer check writing services. They are safe. They are FDIC insured, just like a savings. Another investing tool, low risk investing tool you might have heard of is a certificate of deposit, often called a CD. They can offer a higher annual percentage yield because by opting for a certificate of deposit, you're telling the bank that you're allowing them to hold this much money for this certain period of time. So because they know they're going to have your money for a certain period of time, they usually offer a little bit higher annual percentage yield than a savings account. It's not as liquid because you're telling the bank, you can hold my money for this certain period of time. If you need to withdraw that money before the time period is up, you'll face fees for an early withdrawal that will be more than the interest you've earned on that CD while it's been in there. So before you invest in a certificate of deposit, you want to make sure that you're not going to need that money for that time period. Certificates of deposits, just like a savings account or a money market account, they are FDIC insured up to $100,000 per person per account. So your money is safe in a CD. You usually need at least $500 to purchase a certificate of deposit. That's pretty much the lowest increment that the bank will allow you to purchase, to obtain. And you can go much higher than that, but realize however much money you put in that CD, it's going to be tied up for a specific period of time. And the safest of all investments, government securities. If you believe that the government is pretty secure and going to be here for a long time, invest in U.S. government savings bonds. They're free of local and any state taxes, so you don't have any extras coming out of it. There's many types of them. Most common is the EE savings bond. You can purchase those at your local bank, and they're issued at face value. It takes them 20 years to mature. So you could purchase a $25 EE savings bond. In 20 years, you'll have doubled your money. You can turn them in before they completely mature, 20 years from when they're purchased, but you'll get a reduced fee or reduced amount for what they're worth. You won't get the full doubling of the face value. There's I-bonds, and they provide interest monthly. Treasury notes, minimum of $1,000 to purchase a treasury note, but if you believe in the strength and security of the U.S. government and our treasury, and you've got $1,000 to invest, you can make some money off of that. Treasury bonds, that's when we're going to talk about bonds in a minute, but bonds is where you're investing in the government's debt, and they mature after 10 years, not 20. And treasury bills, short term and mature to face value. You buy real short investment tool, but most common one is the EE. I had a in-law whose a standard operating procedure for all his grandkids was to buy an EE savings bond for each one on their birthday and Christmas. So by the time they were old enough to go to college, they'd have some of those government securities to turn in for possibly textbooks and tuition, but they would have some sort of return in the future. That was a nice thing for him to do to help get them started. And then there's cash. Cash is king, right? Well, you don't earn interest on cash. It is what it is. You got a $20 bill, it's always going to be a $20 bill. We'll talk about towards the end of this presentation, about how it might actually not be a full $20 bill, but we'll get there. Also, they're not as safe. Cash can disappear really easily. It can fall out of your pocket. It can be stolen. You could put it under the mattress, and hopefully it'll still be there when you get home. And the nice thing about it, it's already liquid. Cash is a liquid asset. You don't have to convert it to anything to spend it. So there's convenience in cash. That was pretty much it for the low risk investment tools. Now we're going to talk about investment tools that might make your heart palpitate a little bit depending on your risk tolerance level. But these are a little bit riskier. Stocks, bonds, mutual funds, and real estate are coming up next. When you buy stock in a company, you're becoming a part owner of that company. You're buying a share of that company, and that gives you a right to vote on their company policies and efforts that are happening. Their board of directors has to vote, and their stockholders have to vote. When you buy that stock, a share of that company, you can choose from two different types, either common or preferred. Of course, the preferred is going to be a little bit more expensive than the common per share, but if the preferred stock means that you'll get paid your dividends. When that company does well, they'll release dividends to the stockholders, and you as a preferred stockholder would be paid those dividends before the common stockholders are eligible to get their money. But both of you come after the bondholders, and as I mentioned before, the bondholders are the people who are buying the debt of that, financing the debt for that company. They get paid first before the stockholders. Whether you're preferred or common, they get paid first. But you want to make sure you research a company before buying a share of their stock. A good rule of thumb is to invest in companies that espouse your own beliefs and values. For instance, if you are against cigarette smoking, you may not want to invest in R.J. Reynolds, the cigarette maker. It would be against your own beliefs and values. to endorse that company. And the rule of thumb basically with stocks, whether they're common or preferred, buy low and sell high. That's what you want to do to make money. You buy that stock at when it's very low priced, and as that company grows and expands and performs well, their stock gets a higher value, and when it gets to a value that you feel is appropriate, then you make the choice to sell, and that's when you make your money. What you don't want to do is buy high and sell low. That means that you're going to lose money. So buy low and sell high with stocks. So I mentioned that investing in bonds is investing in debt. Well, that's right. Sometimes municipalities, cities, and towns or big businesses need to invest to build their corporation, their company, or their city. Maybe it's a city that needs to build a bridge. They don't have all the money they need, so they float, it's called float a bond, and allow investors to pay for that project, and they agree to pay back those investors with interest over time. So that's how a bond works. You're making a loan to a company or a government for them to do a specific project. You receive face value when the bond matures. So that means, well, we're going to talk in just a minute about how to read the bond information. So I don't want to confuse you yet until you can see what it looks like on the screen. So when the bond matures, you get the face value. You buy it at less than the face value, and you get the face value when it's done. You can receive interest payments at what they call a coupon rate during the maturity period. So say it's a 20-year bond because the city thinks it's going to take 20 years to pay back the building that bridge. Over that 20-year period, you may receive interest payments, those dividends from that bond. So it could provide some current income while you're waiting for it to mature and get your money back out of that bond. And you might have heard of junk bonds. It was a common thing a few years back, but just keep in mind that those are more risky types of investment in debt. So maybe they're more speculative because the powers that be that determine the safety of an investment or a company are thinking, I'm not sure that this company is actually going to be able to pay this debt back. They think they can, but maybe they can't. And if you decide to invest in that high risk junk bond, you're like, well, I really think they can pay that money back. I'm going to get a high reward for them being more solid than everybody else thinks they are. See how it's like gambling? That horse is going to go the fastest. I know it is. Then you can stand to get a high reward, but high risk, high return, or high loss. And then there are mutual funds. The beauty of a mutual fund is that it is already diversified. It is where you invest your money with a lot of other investors, and the mutual fund company, the management company, they watch the performance of all the different pieces and parts of that mutual fund, the stocks, the bonds, and other accounts that are all packaged together in one diverse fund. They watch it and manage it carefully, and by diversifying and careful management, that the value of that mutual fund should go up most of the time. So it's a combination of stocks and bonds that's overseen by a company, and that is it provides that diversification that you need to make sure you're not putting all your eggs in one basket. You have, by investing in a mutual fund, you're already investing in professional management, and it's a really relatively low cost share. A lot of retirement plans focus on mutual funds instead of strictly stocks or bonds, and because it's seen as less of a risk because it's managed over time by professionals, and they're very convenient to use, and easy to get your money back out of. You just sell your mutual fund on the market. What I forgot to mention about stocks and bonds is you can sell those on the stock market as well. So, but realize that you want to buy low and sell high. Same thing with mutual funds. But there is, if you can get your money back out of them by selling them on the market. There are a wide variety of fees that go with mutual funds, and you want to make sure that you do your research to find out what kind of fees you'll be facing, what those are, and how likely you are to be able to grow, get a return on this investment based on all those additional fees for the management. Many people will tell you that a home is not an investment, it's a home. That's right. But it can be an investment as well. When we're talking about real estate as a way to invest, we're talking about the land, the structures, mineral rights, and crops that can be purchased and resold for an increase. The best return is usually on commercial properties, and there are many benefits to real estate. The return rate is usually equal to the inflation rate. We're going to talk about the time value of money at the end, but that was another term for inflation, really. So you can keep pace with the economy by investing in real estate. There usually is a price appreciation. That means the price of homes and real estate usually goes up. In 2008, though, a lot of people learned that word usually is very important. There was a housing crisis, and a lot of home values fell, and a lot of people lost money. Some people lost value but didn't lose money, because you wouldn't lose money until you actually sold that home for less than you paid for it. Just like with stocks, you want to buy low and sell high. Same thing with real estate. You want to purchase that land or that structure for a low cost, and to make money off it, sell it for higher than you paid. There are disadvantages, though. The number one, cost. Real estate's not really cheap. You can buy a mutual fund for I don't know, $6. On average, there's a lot higher and a lot lower, but you're going to pay a lot more than that to get a home or a commercial property. Plus, as I mentioned before, the liquidity is an issue. If you need your money back out of that investment, you need to find a buyer that will buy that from you. And real estate sales don't happen very fast most of the time. A lot of people invest in retirement plans as a way to make sure that they can still afford to live in the manner in which they're comfortable after they stop working. And retirement plans, there's different types, but basically they all invest in mutual funds, stocks, and bonds to help your money grow. There are types of employer plans, most commonly a 401k. You might invest in an individual retirement account, an IRA, or a Roth IRA, which has a little bit different parameters and gives you more flexibility if you plan to work longer. There's the Keogh type plan for those self-employed, those business owners. No matter what type of retirement plan you're investing in, or what kind of financial tool that you're looking to invest in, or stocks and bonds and mutual funds, you need to know how to read the information about those funds so that you can make better decisions. So that's what we're going to do next. We're going to learn how to read the stock reports. So, when you look in the newspaper, I don't think they're printed in the newspaper anymore. The stock reports used to be in there every day. Took up a lot of ink and pages, didn't it? This is the information. What you see on the screen for the next few screens is we're going to break that down so you can understand what you're looking at when you see that. So what they talk about first is how that stock has performed in the last year, 52 weeks. So you see the high here, $74.63 was the highest price paid for one share of this certain stock in the last 52 weeks. The lowest anybody paid was $44.13. That's a $30 difference. per share that you could either gain or lose over the last 52 weeks. And what stock are we talking about? Well, there, the name of the company is going to be abbreviated so it fits in the space allotted for reporting this. And the general guidelines that were used in the past, because it was such a lot of information that had to fit on a newspaper page, that is really not the case anymore since everything's electronic, but this is how it started out. So Genelec, also known as GE, their stock symbol that is used by the stock exchange to track their shares of stock. You want any stock you're going to be investing in, you want to make sure you're familiar with what the symbol is and what the numbers mean. So we know that the symbol for this stock we're talking about, the company that owns this, that sold this stock, is GE. We're talking about a share of stock in the company General Electric. What they're going to show us next under Div is if that company decides to release dividends, pay its investors on a quarterly or annual basis, that amount there, $1.04, is how much that company will pay each shareholder for each share of their stock. So if I owned 10 stocks of GE and they were going to release dividends, I'd be making $10.40. Not bad. Also, the percentage of dividends to this current stock price, that's an important thing to know. We want to know, how much of if we're going to invest a certain dollar amount in this stock, what percentage can we expect to get a return on a regular basis? Well, 1.6 is the percentage dividend at the current stock price. 1.6% of its value is being released on an incremental basis to the people who own shares of stock in that company. And then the next thing is the price to earnings ratio. The higher this number is, that indicates that investors feel that the earnings are likely to grow, that this dividend of $1.04 is likely to go up. So a price to earnings ratio average between 15 and 25. This one's a little bit, 29 is a little bit above average. So investors somehow feel that this dividend is the earnings are likely to grow. That's based on their interpretation of decisions that the board has made, the amount of debt this company carries. They put all that information into their own formulas and come up with a price to earnings ratio that gives us an idea how much we should expect to make, or how likely this stock is to earn money in the future. And the next thing we might want to know is how many of these shares are there out there on the market? How many people also own stock in this company? Well, this volume expressed in 100s will tell you that. You see this number here, it says 43,450. Well, expressed in 100s, that means that there are 4,350,000 shares of this GE stock on the market. And the highest price that anybody paid for any share of this company in the last 24 hours was $69 even. The lowest price that anybody paid in the last 24 hours for this GE stock is $66.75. And yesterday, when the stock market closed, the last share that was sold for $66.88, just a little bit higher than the low for the day. So that was just not even a $3 change over the course of the day in the cost of that stock. And we see that the net change from the close of yesterday's to the day before is actually down $1.75. So everybody who owned a share of that stock at the close of the business day lost another $1.75 on each share. The value of it, the value of selling that stock, lost $1.75. So that's how to read the financials information, and that should give you a good idea of how volatile or how stable a company is. If you see wide swings in these numbers, there's a lot of volatility, a lot of uncertainty, and investors don't like uncertainty. They like safe bets, most of them. You'll see the market rewards companies for their stability. Now we're going to look at how to figure out what they're talking about when somebody's saying that this bond is a good investment. Here we have the same GE company, GE Capital. They're going to issue a bond. They must have some project. Maybe they need to build a new factory and they need some money for that. They're going to float a bond with a 5% coupon rate. Don't get too confused by the terminology. Just understand that that 5% is the yield, annual percentage yield, that investors should expect to make on this, on buying into this bond. Now, if I'm investing in this bond, I want to know when I'm going to get my money back out of it. This bond happens to be maturing November of 2025. So if I were to purchase or buy into this bond, I would expect to get my money back with interest in November 2025. And for the latest trading period, $100 was the highest price anybody paid to buy into this bond. The lowest price anybody paid in the last 24 hours for the trading period, sorry, not the last 24 hours, not the stock market, but the lowest price anybody paid during the trading period was $97.77. And at the close of the day yesterday, or the last closing price, depending on the trading period, that the last price this bond sold for was $98.99. So that's a little bit under the high there. So the cost of investing in this seems to be going down a little bit, doesn't it? So on the last screen, we actually already looked at the last price paid for this, buying into this bond, $98.99, and that was a change, a positive change of $1.03, almost 4 cents, compared to the close of the previous trading period. So the cost of this has actually gone up a little bit, and the yield on this bond, notice it's above the 5% coupon rate. This bond's actually doing better than they expected it to. So it has a 5.21% yield rate. So you can stand to make some money off this bond if you invested in it. So now let's talk about mutual funds. But we had mentioned already that by owning a share in a mutual fund, you're already diversified. There's a manager who's looking at all the pieces and parts of that mutual fund and making sure that it stays a positive performing investment. So for example purposes, we're looking at the Aetna Advisor mutual fund. And then you'll see the net asset value, the cost, the actual value of one share of this mutual fund is $17.73, which you'll see is actually an increase of 7 cents over the last day. And also you'll see this mutual fund has a positive return on the investment of 26%. So the percentage return on each share that you'll receive over the previous year's value. So mutual funds are a good way to diversify your investments and automatically have a fund manager. And what about all the other investment tools that we didn't mention yet? There's futures and options and collectibles. Those are those high risk investments. You want to buy gold and hope to get a return on it? I would get some advice from a professional before doing so, especially in futures. If you've ever seen that movie Trading Places, that long old movie that had Dan Aykroyd and Eddie Murphy, they talked about orange juice futures, and it made it look like so much fun to invest. And it was kind of on track, but it's made it look a lot easier than it really is. Unfortunately, a lot of people get duped by those collectibles. Anybody else have Beanie Babies in their attic? I'm not raising my hand, really. How about that friend that you know that always buys that fixer-up car? I'm gonna buy this old junker car, this rust buckets. I can get it for $500, and I'm gonna sell it for $10,000 because I'm gonna fix it up, and everybody wants these old cars. Yeah, by the time but that is possible, but more likely that will end up being a project car that is not going to cause a return on that investment. You're very lucky if that kind of a investment can pay off. So higher risk does equal higher reward, but it also can equal higher loss. Keep that in mind. And the higher the intricacy of the investment tool that you're looking at, the more you really want to consider turning that type of an investment over to a professional to manage for you, and realize that a lot of times those higher risk investments cost higher to get into. So we're talking about the low cost, low risk, and medium risk investment tools today. If you want something more, if you're just the risk taker and want to get into those futures and options, there's another class for that. Now that you've learned about the tools of investing, that you might want to know where you can invest and where to get involved with an investment. Well, you might already be part of an investment program through an employer provided retirement fund like a 401k or a deferred comp program. If you are, then you'll want to talk to the company that manages that account for you and see what they recommend for your investment goals. You might work directly with an investment firm to select certain investments, and you'll want to make sure you understand the fees associated with any of those two options. If you want to do it yourself, there are financial apps that you can download even to your phone and start investing in small increments to help you get the hang of it and understand what it's like. It gives you tools for researching certain stocks and bonds and mutual funds, and that allows you to dollar cost invest with small increments of money. So it's a nice way to put your toe in the water and see what you think of it. Also, if you're comfortable with your level of knowledge about a company and the investment tools, you might direct invest directly with that company on their website. Certain major companies, like some oil manufacturers I can think of, have a link on their website where you might choose to invest directly to them. So you can research that. But no matter where you invest and where you choose to send your money, make sure you understand any fees associated with it, how liquid your funds will be, and how much access you can have to those funds. There was a problem actually with one of the financial apps, and I'm sure they fixed this now, but when there was a stock market crash, and this one financial investing app went offline, and its members could not move their money out of the market before their balances fell. So make sure you know how connected they are, how stable their systems are. There's a lot to think about. But like I said, it's those financial apps are small increments that you can invest just to find out what you think. And I mentioned the time value of money previously, and we really need to think about this because it is necessary to increase the value of your money over time because of the cost of living. Think about a loaf of bread. How many of us heard our grandparents go, oh my gosh, I used to be able to buy a loaf of bread for 50 cents. Doesn't happen anymore, does it? A dollar will buy you less today than it would a year ago. And that's called the time value of money. If you want to make sure that the money you have will still buy you as much tomorrow as it does today, you have to grow your money and earn at least 3% annually to maintain its current value, because that's about how much the inflation is over the year. About 3% is how much prices change over the year. So we want to make sure that we don't lose the value of our money. A lot of people are comfortable with putting their money in an envelope underneath the mattress. And that's, hey, if that works for you, great. Be careful not to get it stolen. Don't let people know it's there. But realize that that money that you're socking away, that $100 that's been under there for 3 years, it will buy less when you pull it out to spend it if you aren't earning interest on it. And that's just what I want to tell you about the time value of money. Your decision, what you do with your money, but I want you to have the tools to help make good decisions about the best use of your money and how to maximize your earning power. I want to thank you for joining me today to learn all about what we need to do to prepare to invest, how to gauge our risk tolerance, what we're going to be comfortable with when we give somebody our money to help make it grow. That's a really scary thing sometimes. We want to learn about the investment tools that we can use and find out which one's going to be the appropriate one for our values, beliefs, and our risk tolerance. Because we need to do this. The time value of money says that if we aren't earning money on our money, we're losing money. And how did we learn all that? Well, you learned it from your local county extension office. Extension is a federal program that is in every state in the nation. It's been around for more than 100 years. And in Florida, we're extremely lucky to have the support that we do, because you can find an extension office in every one of Florida's 67 counties. We're just a phone call away, we're a drive away, or an email away to help you to make better decisions using research-based, non-biased information. And take advantage of your local county extension office, because your tax dollars already pay for it. So if you're not taking advantage of us and using our resources, you're leaving money on the table. And we don't want that to happen, do we? We need that money so we can invest it and become more stable in our financial future. I appreciate your time today, and I look forward to being able to provide you more helpful information in the future. Happy investing.